Have you ever wished you had a secret signal? You know, something to warn you that a really strong market trend is just about to run out of gas and reverse? Well, today might be your lucky day. We're going to unlock the power of something called RSI divergence. It's a fantastic tool that can help you spot these hidden turning points, sometimes before anyone else does. I mean, that's the million-dollar question for any trader, right? We've all been there. You see a stock or a currency just ripping higher, but you get that little gut feeling that it's running out of steam. So how do you get a real concrete clue that the tide is about to turn? Well, that is exactly where RSI divergence comes into play. All right, so the main tool we're going to be using for this job is the Relative Strength Index, or RSI for short. The easiest way to think about it, it's like a momentum meter for the market. See, the RSI doesn't just track the price itself, it's tracking the strength behind those price moves. It's constantly asking, hey, is the buying pressure getting stronger or weaker? Is the selling pressure picking up? And it gives you the answer as a simple number between 0 and 100. Now, in a normal, healthy trend, the price and the RSI, they're like best friends. They move in sync. If the price is chugging along making new highs, the RSI should be right there with it, also rising, confirming all that strong momentum. And if the price is falling, the RSI should be falling too. This is how things are supposed to work. But what happens when they suddenly stop agreeing? That's when things get really, really interesting. This disagreement is what we call divergence. And honestly, it's a huge clue that the current trend might be in some serious trouble. This analogy is just perfect. Picture it. The car, which is the price, is still rolling forward, still has that forward motion. But the engine, the momentum, has just died. So what do you think is going to happen next? Yeah, that car is probably going to slow down, stop, and maybe even start rolling backward. So here's the bottom line. You've got the normal condition on the left, where price and RSI are in total agreement. That's a confirmed healthy trend. But on the right, you get the divergence condition. They're sending completely opposite signals. Price is saying one thing, but the momentum is saying something else entirely. And that's the anomaly we're hunting for. Okay, so let's dig into our first type of divergence. It's called bullish divergence, and it's a little counterintuitive because it actually shows up during a downtrend, signaling that things might be about to turn around and head up. So here's the exact pattern you need to look for. The price on your chart makes a new lower low than before, but, and this is the important part, at the exact same time, the RSI indicator makes a higher low. This is a massive tell. It's suggesting that the selling pressure is seriously fading, even as the price itself is still dropping. And finding it is a really simple three-step process. First, you spot two falling lows on your price chart. Step 2, you look straight down at your RSI indicator for those same 2 points in time. And step 3, you confirm it. Is the second low on the RSI actually higher than the first one? If the answer is yes, boom, you've just spotted bullish divergence. Let's see this thing in action. Take a look at this chart. The price makes a low right here, and then it drops and makes an even lower low over here. Classic downtrend, right? But now look at the RSI below. The first low is way down here, but the second corresponding low is clearly higher. The price is falling, but the downward momentum is dying. And what happens next? A powerful reversal right to the upside. Okay, now let's flip it around. Bearish divergence is the exact opposite. It shows up in a strong uptrend and acts as a warning that the whole rally might be losing its power. For this pattern, you're on the lookout for the price making a new higher high, but at the same time, the RSI is making a lower high. The price is still climbing, which looks great on the surface, but underneath, that buying momentum is just fading away. And the process is exactly the same, just inverted. First, find a new peak, a higher high on the price chart. Then you locate those same peaks on the RSI. And finally, you confirm that the second peak on the RSI is lower than the first one. That's your bearish signal right there. Now, what's so great about this chart is just how clear this signal is. You can see the price pushing up to a new high, which on its own looks super strong. You'd think, wow, this is going to the moon. But the RSI is telling a completely different story. This peak right here on the indicator is way lower than the previous one. This is that engine cutting out we were talking about. And sure enough, the market stalls and heads down. So we've covered the two main types, bullish and bearish. But how do you actually use this information effectively in your trading without getting faked out? Let's quickly summarize the key points you need to remember. Think of this table as your ultimate cheat sheet. For a bullish signal, you're looking for price to hit a lower low while the RSI hits a higher low. For a bearish signal, you want a higher high in price against a lower high in the RSI. Simple. It's all about that opposition, that disagreement between the two. And please remember these rules. They're absolutely crucial. First, divergence is a warning signal. It's not a crystal ball. It signals that momentum is weakening, but it does not guarantee a reversal is about to happen. Second, and this is a big one, always use it as a confirmation tool alongside your other analysis. Don't trade on it by itself. And finally, before you even start looking for divergence, you have to get really good at just identifying the significant highs and lows on your chart. So there you have it. That's a clear breakdown of RSI divergence. It's such a powerful signal because it tells the story that's happening just beneath the surface of the price action. The real question is, now that you know what to look for, how are you going to use this new insight to better read the markets? We hope this helps you out.